Thank you for watching Investments in Marketable Securities. We hope you find something interesting and learn something new about accounting for income tax. According to dictionary.com, marketable securities are defined as very liquid securities that can be converted into cash quickly at a reasonable price. Marketable securities are very liquid as they tend to have maturities of less than 1 year. Furthermore, the rate at which these securities can be bought or sold has little effect on their price. Some of Investopedia's examples of marketable securities include commercial paper, bankers' acceptances, treasury bills, and other money market instruments. Today we will be focusing on financial and tax aspects of this other category, which includes trading, available for sale, and held-to-maturity securities. In each discussion, we will use the cost method of accounting viewpoint because we do not have significant influence, which is having less than 20% ownership. So let us start with the financial aspect of a trading security. A trading security is a debt or equity security that is purchased mainly with the intent of reselling the security in the short term. The trading security will show up in 3 financial statements. First, balance sheet. We will initially purchase a trading security and record it at fair market value as a current asset. We will also create a valuation account called unrealized gains or losses trading securities to record any changes in fair market value. Second is the income statement. For a trading security, we must record changes in value during the period in which they occur, whether that change has been realized through an arm's length transaction or not. These changes are either reported under the other income or expenses account or combined with dividends and interest revenue in one item called net investment income. Finally, the cash flow statements. We record the changes in the realized or unrealized gains and losses in the operating section. Losses, whether realized or not, are added when using the indirect method of accounting, and gains are subtracted, again whether realized or not. Surprisingly, nothing goes on the investing portion of the cash flow statement. Let's take a look at an example. In January of 2011, you purchased a trading security for $100. During the year, the value of the asset increased by $15. What is to be recorded on the balance sheet, income statement, and cash flow statement for the year of 2011? On the balance sheet, we would record the trading security as a current asset for $100. We would also create a valuation account called unrealized gains and losses trading securities to record any changes in fair market value. Since we know that the value of the trading security went up by $15, we will record this on our balance sheet. Because we have had an increase in the value of our trading security, we must report the gain of $15 on the income statement in the other income account, even though the change has not been realized through an arm's length transaction. We record the changes in the unrealized gain in the operating section. Remember that gains are subtracted whether realized or not. Now we will move on to the tax aspect of trading securities. There are 3 main things that you need to remember about the tax implications of a trading security. First, it is to be recorded at the fair market value purchase price, just like for financial book purposes. Second, gains and losses are only recognized upon the sale of the security, not when there is an unrealized gain or loss. This is important because it is what creates the book tax difference. Third, because of the recording of unrealized gains and losses recorded on the books, which are not considered for tax purposes, deferred tax assets and liabilities are created. Let's go back to our original example for trading securities. Remember that we purchased a trading security for $100 and recorded it on the books. We also had an unrealized gain of $15, so now we need to discuss the book tax recognition differences that arise. We purchased a trading security for $100 and recorded on the books. We have now learned that it's the same for tax purposes. However, on our books we have recognized the unrealized gain of $15 for the security, and we do not do this for tax purposes. Tax law operates under the realization principle. Unrealized gains and losses are generally not reported on the tax return and must be backed out of book net income when converting to taxable income, so we end up with 2 different totals, leaving us with a $15 difference. Since for tax purposes we don't have to recognize the unrealized gain this year, we have a favorable situation. A deferred tax liability of $15 is created because we know that the unrealized gain will have to be recognized in a future year when the trading security is sold, creating an unfavorable situation. If we change our example so that we have an unrealized loss instead of an unrealized gain, we would have the opposite situation with our book total being $15 less than our tax total, leaving us again with a $15 difference. For tax purpose, we must realize the full value of the trading security since the loss has not yet been realized. This leaves us with an unfavorable situation of having to pay extra tax this year. However, a deferred tax asset is created, and we know that in a future year, when the trading security is sold at a loss, we will be able to recognize the loss for tax purposes, which will provide us with a deduction in that particular year. An available-for-sale security is a debt or equity security that is purchased with an intent of selling before it reaches maturity, but it is not actively traded. The available-for-sale security will show up in 3 financial statements. First, the balance sheet. We will initially purchase an available-for-sale security and record it at fair market value under stockholders' equity, and use the unrealized gains and losses to show direct adjustments to equity. Second is the income statement. For an available-for-sale security, the unrealized gains and losses are excluded from net income and included in comprehensive income. Finally, the cash flow statement. We record the changes in the realized losses in the operating section. We record the purchase and sale of securities in the investing section. Let's take a look at an example. In January of 2011, you purchased an available-for-sale security for $100. During the year, the value of the asset increases by $15. We need to figure out what is going to be recorded at the balance sheet, income statement, and cash flow statements for the year of 2011. On the balance sheet, we would record the available-for-sale security as part of the stockholders' equity section for $100. We also create an account called Market Adjustment, Available for Sale, where we will be able to record any changes in fair market value. Since we know that the value of the available-for-sale security went up by $15, we record this on our balance sheet in our new account. Because we have an increase in the value of our available-for-sale security, we must report that gain on the income statement, even though the change has not been realized through an arm's length transaction. This $15 will be reported in the other comprehensive income after net income. On the cash flow statement, we do not record anything under the operating section because we have not had any realized gain or loss on the available-for-sale security. We record the purchase of the available-for-sale security in the investing section. Now we will move on to the tax aspect of the available-for-sale securities. There are 3 main things that you need to remember about the tax implication of an available-for-sale security. Number 1, it is to be recorded at the fair market value purchase price, just like for financial book purposes. Number 2, gains and losses are only recognized upon the sale of the security, not when there is an unrealized gain or loss. And number 3 is that there are no deferred tax assets or deferred tax liabilities created. That is what makes available-for-sale securities different from trading securities. Let's go back to our original example for available-for-sale securities. We had purchased an available-for-sale security for $100 and recorded it on the books. We had an unrealized gain of $15, so now we need to discuss the books tax recognition differences that arise. Because we only recognize realized gains and losses on our books as well as for tax purposes, there are no differences. The final type of security we will discuss today is held-to-maturity security. A company purchases this type of debt security with the intention to hold it until maturity. Held-to-maturity securities also affect 3 financial statements. On the balance sheet, held-to-maturity securities show up as current or non-current assets depending on their date of maturity. This investment, held-to-maturity, is the only account we deal with and the only account that shows up on the balance sheet. On the income statement, because a company purchases held-to-maturity securities without the intent to trade, we do not recognize unrealized gains and losses. Therefore, they never show up on the income statement. Only realized gains and losses, which are in the form of interest income or discount and premium amortization, go through the income statement. On the cash flow statement, we record both the purchase and sale of the security in the investing section. Interest, income, and amortization appear on the operating section. Most of the accounting for held-to-maturity securities is straightforward without many journal entries between the dates of purchase and maturity, although the amortization of a discount of a premium can be a bit confusing. The theory is, regardless of the price you pay for the security, at the date of maturity the debt will be redeemed for its face value. Thus, in between the date of purchase and the day of maturity, you must amortize the difference between purchase price and face value. This can sometimes increase the value of the investment if it was purchased at a discount, or decrease the value of the investment if it was purchased at a premium. Every year, the journal entry for the amortization is as follows. This is an example of a debt premium amortization. If you have a bond purchase at a discount, you reverse the entry with investment being debited and the interest revenue account being credited. The one question that still remains with held-to-maturity securities is if there are any book-to-tax differences that arise during the life of the security. The short answer is no. Book-tax differences often occur when unrecognized gains or losses affect the security, but because held-to-maturity securities do not have unrecognized gains or losses, income recognition is the same for both forms of accounting. Again, there are three types of security: trading, available for sale, and held-to-maturity. All have different ways that they should be accounted for. Hopefully you now have a better idea of the accounting, the financial accounting, tax accounting, and unique financial issues that can occur. Thank you for watching.